The American family budget is in crisis. People are cutting streaming, skipping trips, buying store brands, driving less, and still the money disappears. A big reason is not one dramatic bill. It is protection itself. Health insurance, auto insurance, home insurance. The products sold as safety nets are becoming monthly pressure points. By the end, you will see why this is not just bad luck or bad budgeting. It is a pricing system most households do not fully see until the renewal notice arrives. Insurance used to feel boring in the best possible way. You paid for it, hoped you never needed it, and moved on. Now it feels like another rent payment hiding inside the budget, except you cannot easily refuse it without risking everything. For many families, insurance is not optional. A mortgage lender wants homeowners coverage. A state requires auto coverage. A medical emergency can wreck a household without health coverage. So when prices rise, people are not shopping like they are choosing a new phone. They are cornered. That is why insurance has become such a powerful pressure point. It sits at the intersection of fear, law, finance, medicine, weather, cars, and housing. Almost every part of ordinary life now touches an insurance policy. The official language sounds calm. Premium adjustment, risk repricing, claims severity, market correction. But at the kitchen table, it sounds different. It sounds like a parent staring at a renewal letter and wondering which bill gets paid late. Health insurance is the clearest example. Employer family coverage has moved into a range that feels almost unreal for ordinary workers. The total annual premium for a typical family plan is now close to the price of a small used car. Yes, employers usually pay most of that premium, but that does not make it free. Money paid by the employer is still part of the cost of employing someone. It can affect wages, hiring, raises, and how much workers see in real life. The worker contribution is painful on its own. Families can pay thousands a year from paychecks before they even meet a deductible. That means coverage can feel expensive before care begins, and expensive again when care is finally needed. This is the emotional trap of modern health insurance. You pay every month to avoid financial ruin, then still hesitate to use care because the deductible, copay, network rule, or surprise balance can make the visit feel risky. A family can have insurance and still feel uninsured. That sentence sounds strange until you hear the stories. The card is in the wallet. The premium is paid. But the first question is still not, how do I get better? It is, what will this cost? Insurance companies are not the only actors in health costs. Hospitals, drug makers, employers, regulators, brokers, and providers all matter. But insurers sit at the gate. They translate the whole messy system into premiums, denials, networks, deductibles, and rules. That gatekeeping creates anger because the customer relationship is upside down. In most markets, a customer pays and expects service. In insurance, the customer pays for the right to ask permission when something goes wrong. Auto insurance has become the next household shock. For years, many drivers treated it like background noise. Then, renewal notices started jumping so sharply that people who had not crashed, moved, or changed cars felt punished anyway. The reasons are real, but they do not make the bill easier. Repairs are more expensive. Cars have sensors, cameras, screens, and complex parts. Labor is costly. Medical claims tied to crashes can rise. Weather can damage vehicles across whole regions. Still, the household experience feels unfair because the price often rises before the family understands why. You can drive carefully for years and still be priced into the same storm of repair costs, claim trends, and regional losses. That is the quiet transformation. Auto insurance is no longer just a personal driving record product. It is also a technology product, a repair market product, a medical cost product, a weather product, and sometimes a credit-based pricing product. When a car bumper contains sensors, a minor accident is not minor anymore. A tap in a parking lot can become a repair that involves electronics, calibration, parts delays, rental coverage, and a claim that follows the driver into the next renewal. So families respond by raising deductibles, dropping extras, delaying claims, or reducing coverage on older cars. On paper, that saves money. In real life, it shifts more risk back onto the household that bought insurance to avoid risk. Homeowners insurance is even more unsettling because it is tied to the biggest asset most families will ever own. If insurance becomes unaffordable or unavailable, the problem is not just a bill. It can affect the value and saleability of the home. In many places, lenders require coverage for the life of the mortgage. Without insurance, a buyer may not get financing. Without financing, the pool of buyers shrinks. When insurance markets strain, housing markets can strain with them. The pressure is not evenly spread. Coastal storms, hail, wildfire, wind, flooding, rebuilding costs, and reinsurance all push differently by region. Some families see modest increases. Others see jumps that change whether staying in the home still makes sense. Climate risk is now being priced into ordinary life. That statement is not political theater. Insurers price risk because they must. If the expected cost of damage rises, the premium follows, or the company restricts coverage, or the state backstop grows. But there is a brutal gap between actuarial math and household reality. A spreadsheet can say the risk changed. A family can say their income did not. Both can be true, and that is why the conflict is so sharp. Flood insurance adds another layer. Many standard homeowners policies do not cover flood damage. Families often learn that only after reading fine print, talking to a lender, or facing a disaster they assumed was covered. That separation matters because water does not care what category the policy uses. A homeowner may think they bought protection for the home, but the policy may treat different kinds of water in very different ways. Then come deductibles. A deductible used to feel like a manageable first step before help arrived. Now, in some policies, deductibles can be large enough that families wonder whether filing a claim is worth it at all. That is one of the central contradictions. Insurance is designed to pool risk, but the modern customer is absorbing more first-dollar risk through deductibles, exclusions, narrower networks, and higher out-of-pocket exposure. Insurers will say they are not charities, and that is true. They are financial institutions built to price uncertainty. They need reserves. They need solvency. They need enough premium to pay claims. Pretending otherwise is not serious. But families are allowed to ask a different question. If the product is essential, legally required, or lender required, how much pricing power should a company have before the market stops feeling like a market? A free market works best when customers can walk away. Insurance often does not work like that. You can shop, compare, bundle, raise a deductible, accept tracking, change coverage, or switch carriers. But for many families, leaving the category is not realistic. This is where the crisis becomes psychological. Every household is told to be responsible. Buy coverage, protect the family, follow the rules. Then the reward for responsibility is a bill that keeps rising faster than the family can comfortably absorb. The anger is not just about price, it is about opacity. People do not fully understand why their rate changed, why a claim was handled a certain way, why one neighbor pays less, or why loyalty can sometimes cost more than switching. Insurance pricing depends on complicated models. Those models can include location, claim history, coverage choices, building materials, vehicle type, repair costs, medical trends, and in many states, credit-based insurance scores. The customer sees only the final number. That final number arrives like a verdict. It does not show the full recipe. It does not say which factor moved the most. It usually does not explain what the family could realistically change tomorrow. This is the same reason grocery bills feel so confusing. A shopper can look at the total and know it hurts, but not know exactly which decisions were theirs and which were shaped by packaging, placement, promotion, and pricing strategy. At the grocery store, inflation is not just one higher sticker. It is a maze. The package may shrink. The coupon may require an app. The loyalty price may hide the regular price. The family size may not be the best value. Private labels complicate the picture. Store brands can save money, and often they are good products. But they also give retailers more control over shelf space, price gaps, and the way shoppers compare value across the aisle. Coupons are not always simple savings. They can steer behavior. A deal can push a shopper to buy a bigger size, a second item, a premium version, or a product they would not have bought at all. Loyalty cards feel harmless because the discount is immediate. But they also train shoppers to accept two prices for the same item: the price for people inside the data system and the higher price for everyone else. Delivery apps add another layer of convenience cost. The visible fee is only part of it. Menu prices can differ, tips are expected, service fees appear, and the habit can turn a tired weeknight into a much larger food budget. Store layouts are built around human behavior. Staples can be spread apart. Impulse items sit near checkout. Higher margin products get better visibility. The shopper thinks they are simply walking through a store, but the path has been designed. Premium products do something similar. They make the middle option feel reasonable. A fancy sauce, organic snack, or convenience meal can shift the frame, so the regular higher-priced option suddenly feels practical. Why bring up groceries in a story about insurance? Because the household budget is not separated into academic categories. Families do not experience health premiums, car premiums, home premiums, eggs, beef, rent, and gas as separate debates. They experience one shrinking margin. The grocery aisle teaches us something important. Consumers often blame themselves for overspending, while systems around them are engineered to make spending feel normal, necessary, or invisible until the receipt appears. Insurance works the same way, except the stakes are bigger. The family does not just risk buying an overpriced snack. They risk being underinsured after a crash, uncovered after a storm, or buried by medical costs after an illness. That is why the phrase personal responsibility is not enough. Responsibility matters. Shopping matters. Reading policies matters. But no individual family can comparison shop its way out of national medical costs, climate losses, repair inflation, and complex underwriting models. One household can switch carriers. Millions doing it creates a shopping surge. But if the whole system is repricing risk upward, switching only changes who sends the bill. It does not remove the pressure from the economy. The industry often tells customers to bundle. Auto plus home. Home plus umbrella. Multiple vehicles. The bundle can help. It can also make customers sticky because leaving one policy may affect the discount on another. That stickiness matters. The more complicated the bundle, the less likely a busy family is to test the market every year. Complexity becomes a moat, even when nobody calls it that. Renewal pricing can exploit attention. The first year may look attractive. Later, the bill creeps up. Many customers do not notice until the increase becomes painful, because insurance is designed to be automatic and forgettable. This is not the same as saying every insurer is cheating. It is saying the structure rewards companies that understand customer inertia better than customers understand the structure. Households are tired because they are asked to manage professional-level complexity in spare moments. Compare deductibles, check exclusions, study networks, understand replacement cost, review prescriptions, evaluate telematics, read the mortgage escrow statement. Most people do not have time for that. They have jobs, children, aging parents, car repairs, groceries, and rent. So they rely on defaults, and defaults are where money quietly leaks. Health insurance defaults can be especially punishing. A plan with a lower premium may carry a higher deductible or narrower network. A plan with familiar doctors may cost more. The cheapest choice may become expensive when someone actually gets sick. That is the uncomfortable truth about choice. Choice only helps when people can understand the trade-off before the bad event happens. With insurance, the real test often comes later, under stress. Imagine a family choosing health coverage during open enrollment. They are comparing acronyms, premiums, deductibles, co-insurance, drug tiers, emergency rules, and provider networks. One wrong assumption can cost them for a year. Now imagine the same family choosing auto coverage. Liability limits, collision, comprehensive, uninsured motorist coverage, rental reimbursement, glass, roadside assistance, deductible options. It sounds manageable until the accident happens. Now imagine homeowners coverage. replacement cost, actual cash value, roof age, wind deductibles, water backup, flood exclusion, ordinance coverage, personal property limits, loss of use. The policy is a language many buyers never fully learn. That knowledge gap benefits the side that writes the contract. Again, that does not mean every contract is unfair. It means the company understands the product at a level the average customer cannot match. This is why insurance frustration cuts across politics. People may disagree about regulation, climate policy, healthcare reform, or corporate profits. But almost everyone understands the feeling of opening a bill and thinking, what changed? The answer is usually not one thing, it is a stack. More expensive care, more expensive repairs, more expensive rebuilding, more severe weather, higher reinsurance costs, litigation trends, fraud concerns, administrative costs, profit targets. Insurers point to claims, and claims are real. If a company pays more to fix cars, rebuild homes, or cover medical care, premiums tend to move. The problem is that the customer rarely sees the chain clearly. Meanwhile, profit and executive compensation remain part of the public anger, especially when families hear that premiums must rise while large firms still report strong results. Even when the accounting is complicated, the optics are combustible. People do not want to lecture on loss ratios when the escrow payment jumps. They want to know why being responsible keeps getting more expensive, and why the explanation always arrives after the bill. One of the sharpest tensions is that insurance works by pooling risk, but pricing is becoming more individualized. The more data companies use, the more each household can feel isolated into its own expensive box. That can be efficient from a pricing perspective. But socially, it changes the promise. Insurance starts to feel less like shared protection and more like a personalized bill for every risk attached to your life. In auto insurance, telematics can reward safe driving for some people. But it can also make customers uneasy. The discount comes with monitoring. The question becomes, how much privacy should a family trade for affordability? In health insurance, wellness programs can sound supportive. But workers may wonder whether health data, incentives, and penalties are slowly turning coverage into a constant test of behavior. In homeowners insurance, mitigation discounts can encourage stronger roofs, defensible space, better windows, and safer construction. That is useful. But upgrades cost money, and many households cannot spend thousands now to possibly save later. So the system often rewards families who already have cash. They can raise deductibles because they have emergency savings. They can fortify homes. They can shop annually. They can pay repairs without filing small claims. Lower-income families face the harsher version. They may choose the cheapest premium because cash flow is tight, then face a deductible they cannot comfortably pay. The monthly bill is lower, but the danger is still there. This is how insurance becomes regressive without announcing itself. The family with less savings pays in stress, reduced coverage, higher risk, and fewer options. Renters are not outside this story. Landlords facing higher property insurance can pass costs into rent when the market allows it. A tenant may never see the insurance bill, but still feel it in the lease renewal. Small businesses feel it too. Commercial property, liability, health benefits, delivery vehicles, workers' coverage. Higher insurance costs can flow into prices, wages, hiring, hours, and the survival of local businesses. That is why the crisis spreads. Insurance is embedded inside almost every price. When a restaurant, contractor, daycare, grocery distributor, or landlord pays more for coverage, that cost looks for a way to move forward. Then policymakers talk about inflation cooling, and households feel gaslit. A category can cool while remaining painfully expensive. A slower increase is not the same as relief. If your premium jumps sharply one year and barely rises the next, economists may say the pressure is easing. But your family is still paying the higher base every month. The old price did not come back. This is one reason official inflation language misses the emotional reality. Families remember levels, not just rates of change. They remember what the bill used to be. Insurance also affects debt. When premiums rise, families may put other costs on credit cards, reduce savings, delay maintenance, or skip preventive care. The damage shows up later, not always in the insurance category. Think about a homeowner who delays roof repair because the household budget is strained. Later, damage gets worse. The insurer may dispute maintenance issues. The family learns that saving money under pressure can become expensive. Think about a driver who drops collision coverage on an older car because the premium feels impossible. One accident later, the car is gone, the job commute is threatened, and the family needs another loan. Think about a parent who avoids a specialist visit because the deductible is high. The illness does not vanish. It waits. Sometimes it becomes more complicated and more expensive. These are not reckless choices. They are trade-offs made by people trying to survive a budget that no longer has room for error. The most frustrating part is that insurance is supposed to create peace of mind. Instead, more families experience it as a subscription to anxiety. Pay now, worry later, argue if something happens. Claims are where the emotional contract is tested. A smooth claim can make a customer loyal for life. A confusing claim can make a family feel betrayed, even if the company follows the policy language. That policy language matters. Many disputes are not about whether the customer suffered harm. They are about whether the harm fits the contract. The gap between human loss and covered loss can feel cruel. To an insurer, exclusions are necessary boundaries. To a family, exclusions can sound like protection disappearing exactly when it is needed. That does not mean all denials are wrong. Insurance cannot cover everything at any price. But when customers do not understand the boundary until after loss, trust collapses. Trust is the real currency here. Without trust, every premium feels like tribute. Every renewal feels suspicious. Every claim feels like a fight waiting to happen. Some regulators have tried to slow or review rate increases. That can protect consumers in the short term. But if rates are held too low while losses rise, insurers may restrict new policies or leave certain markets. That is the hard policy puzzle. Let prices rise too fast and families get crushed. Hold them down too aggressively and coverage can become harder to find. There is no magic button. State backstop programs can help when private markets pull back. But they can also concentrate risk and leave taxpayers or policyholders exposed after major disasters. A backstop is not free money. It is risk moved to another pocket. The same is true in healthcare. Subsidies can make premiums affordable for some families, but the underlying cost of care remains. Someone pays, whether through premiums, taxes, wages, or public debt. This is why simple slogans fail. The problem is not just greedy companies, and it is not just irresponsible consumers. It is a system where essential protection is tied to markets under stress. Still, incentives matter. A company that can raise premiums, narrow coverage, push customers toward higher deductibles, and rely on customer confusion has incentives that deserve scrutiny. Families know this instinctively. They know when a product becomes harder to understand, the confusion rarely benefits the person with less information. That is why transparency should be a basic demand. Renewal notices should explain the main reasons for increases in plain language. Policies should make major exclusions impossible to miss. Shopping should be easier without surrendering personal data everywhere. Consumers also need practical defenses. Shop before renewal, not after the bill is due. Compare the same coverage, not just the lowest premium. Ask what changed. Check deductibles. Look for exclusions. Review whether bundles still save money. For health coverage, the defense is slower and more careful. Look beyond the premium. Check the deductible, out-of-pocket maximum, drug coverage, networks, and whether regular doctors are truly in plan. For auto coverage, do not cut liability too low just to save a few dollars. A cheap policy that leaves you exposed after a serious crash can be the most expensive choice you ever make. For homeowners coverage, ask about replacement cost, roof rules, wind or hail deductibles, water backup, flood exposure, and whether local rebuilding costs have changed. The goal is not just a lower bill, it is a policy that works. Families should also build an insurance file. Keep photos, receipts, repair records, policy documents, and notes from calls. When a claim happens, memory is weak. Documentation is power. At the grocery store, the same discipline helps. Compare unit prices. Watch package sizes. Use loyalty deals intentionally. Do not let coupons decide the menu. Choose convenience when it is worth it, not because the system nudged you there. These small habits will not solve the national insurance crisis, but they can reduce the quiet leaks that make premiums feel even heavier. The deeper fix requires public pressure. Regulators need data. Lawmakers need to understand that insurance affordability is housing policy, health policy, transportation policy, and family policy all at once. Insurers also need to rebuild trust, not with slogans, but with clearer contracts, fair claims handling, realistic mitigation credits, and pricing explanations that ordinary people can understand. If companies want customers to accept risk-based pricing, they should not hide behind language only specialists understand. Plain explanations are not a favor. They are part of earning legitimacy. The industry also has to be honest about where markets are becoming strained. If some areas are becoming harder to insure, pretending everything is normal only delays the shock. Communities need honest risk information too. Homes should not be sold with vague comfort while insurance, flood, fire, wind, and rebuilding realities are left for buyers to discover late in the process. That includes local planning. Building in risky places, underpricing risk, and then acting surprised when premiums explode is not a sustainable housing strategy. But families already living in those places cannot simply be told to move. Their jobs, schools, equity, relatives, and histories are there. A policy answer that ignores that reality will fail. The crisis is not just coastal. Hail, wind, fire, flood, freezes, and severe storms can hit inland communities. The old mental map of risky places is outdated. Insurance markets are becoming a warning system. When premiums rise or carriers pull back, they are sending a signal about risk, cost, and uncertainty. The tragedy is that families receive the signal as a bill. And unlike a weather alert, this warning does not tell you what to do next. It just says pay more, accept less, or search harder. That is why so many households feel trapped. They are not asking for impossible protection at impossible prices. They are asking for a system where doing the responsible thing does not become financially punishing. The phrase insurance crisis can sound dramatic, but for many families it is simply Tuesday. The car policy renews. The escrow changes. Open enrollment begins. The grocery receipt grows. The margin shrinks. Then the culture tells them to budget better. Budgeting helps, but budgeting cannot fully solve a world where required protection keeps taking a larger share of ordinary income. Financial advice often focuses on coffee, subscriptions, and impulse spending. Those matter. But a family can cancel small luxuries and still be overwhelmed by premiums, deductibles, rent, food, utilities, and car costs. This is where the story gets uncomfortable. The American household is being asked to self-insure more risk while paying more for insurance. That is the squeeze. Higher deductibles mean the family carries more of the first loss. Narrower coverage means more exceptions. Higher premiums mean less cash to save. Together, those changes reduce resilience. Resilience is not a buzzword here. It is the ability to absorb a broken transmission, a medical test, a roof leak, a job loss, or a storm without falling into debt. When insurance becomes too expensive, resilience weakens. When coverage becomes too confusing, resilience weakens. When claims feel uncertain, resilience weakens. That weakness shows up quietly. Parents delay dental care, drivers avoid repairs, homeowners skip maintenance. Families keep older appliances running. People hope nothing happens because one bad month could break the plan. The hardest part is that the bill rarely announces itself as a crisis. It arrives in pieces. A little more from the paycheck, a little more in escrow, a little more for the car, a higher deductible that only matters after something breaks. A pharmacy price that changes when the plan year resets. A roof rule nobody mentioned at closing. A letter saying the policy will renew, but with different terms. Each piece can be explained. Each piece can be defended. But families do not live in pieces. They live in totals. They live with the combined effect of every company, every model, every risk score, every supplier cost, Every weather event, every medical charge, every repair estimate, and every policy limit landing on one bank account. That is why the crisis feels invisible to people outside the household and obvious to the people inside it. The budget does not care whether the reason is actuarial, medical, legal, environmental, or corporate. It only cares that less money is left after the necessities are paid. And when people say the system is working because claims are still paid and companies are still regulated, that misses the lived reality. A system can function on paper and still feel broken to the families using it. A claim can be legally handled and still leave a person exhausted. A premium can be actuarially justified and still be unaffordable. A deductible can be clearly written and still be unrealistic for a household with no emergency cushion. A discount can be available and still be out of reach if the customer cannot afford the home upgrade, the safer car, the higher credit score, or the annual shopping time required to capture it. This is the uncomfortable middle ground. The insurance market is not imaginary. The risks are not fake. The costs are not made up. But the burden is landing in a way that makes ordinary families feel as if protection has become another product designed for people with more cash, more time, and more room for mistakes. The same burden shows up at the supermarket in a smaller but revealing form. A shopper may think the price of a family dinner is a personal choice, but the aisle has already shaped the choice through package size, shelf placement, loyalty pricing, private labels, promotional timing, and convenience shortcuts. Insurance does this with contracts instead of shelves. It shapes the choice through deductibles, renewal timing, coverage tiers, bundled discounts, exclusions, and the fear of being unprotected. In both places, the customer is told they are free to choose, but the choices are framed by institutions with better data and more patience. That imbalance is not always abusive, but it is always powerful. A household can try to fight back, but it is doing so after work, after school pickup, after dinner, and after every other decision of the day. The company has teams, models, lawyers, pricing departments, and renewal systems. The family has a kitchen table and an hour before bed. That difference in time and expertise is one of the quietest forms of power in the modern economy. It is why even careful people can feel trapped. That is the part families notice long before economists, regulators, or executives admit the pressure has changed. Insurance was supposed to reduce that fear. It still can. Good coverage, fairly priced, clearly explained, and honestly handled is valuable. Nobody should pretend the product itself is useless. The crisis is that the value proposition is cracking. Families are paying more and feeling less protected. That is the sentence that explains the anger. And it is not enough for the industry to say claims are expensive. Customers know life is expensive. They are asking why the pain always seems to be transferred downward to the household. One answer is that households are the final shock absorber. When hospitals charge more, when parts cost more, when storms destroy more, when rebuilding costs rise, the bill eventually arrives at the family. Another answer is that complexity protects margins. The harder a product is to compare, the easier it is for customers to overpay, underinsure, or stay put out of exhaustion. That is why the next phase of consumer protection should focus on comparability. Families should be able to see not just the premium, but the real trade-off. What is covered, what is excluded, and what happens after a common loss. Imagine insurance labels as clear as nutrition labels. Not perfect, not oversimplified, but readable. Major exclusions, deductible triggers, renewal factors, and claim steps displayed before purchase, not buried after commitment. That would not fix weather risk or medical costs. But it would reduce the information gap, and the information gap is where much household frustration lives. Some people will say, just shop around. That advice is useful but incomplete. Shopping helps most when markets are competitive, products are comparable, and customers have time. Many families have only one of those three. Others will say, just raise your deductible. Again, useful for some, dangerous for others. A higher deductible is not savings if you do not have the cash to pay it. Others will say, just move away from risky areas. Sometimes that is rational, but moving has costs, and many risky areas are also where families have deep roots or lower housing options. Others will say just choose a cheaper health plan. But a cheaper plan can mean fewer doctors, higher out-of-pocket costs, or more trouble when the family needs care. So the honest answer is layered. Families should shop smarter, document better, and question every renewal. Companies should explain more clearly and handle claims fairly. Regulators should demand data and watch availability. Communities should reduce risk before disaster. That is not as satisfying as a villain story, but it is more useful. The crisis is not one evil button someone pressed. It is an incentive machine, and households are caught inside it. The machine rewards pricing risk precisely, but it does not always protect people humanely. It rewards complexity, but ordinary families need clarity. It rewards shifting risk, but families need stability. American families are not weak because they are angry about insurance. They are paying attention. They can feel when a safety net starts acting like another weight. And once you see the pattern, you see it everywhere. The grocery aisle trains you to chase deals. The health plan trains you to avoid care. The auto policy trains you to fear claims. The home policy trains you to study weather like an investor. That is not normal household life. That is risk management for people who never signed up to become risk managers. So here is the takeaway. Premiums are rising because real costs and risks are rising. But the pain is magnified by complexity, weak transparency, customer inertia, and a system that often shifts more responsibility onto families. The second takeaway is that households cannot solve this alone. Smart shopping helps, but it is not a national strategy. We need clearer rules, better risk reduction, stronger competition, and plain language accountability. The third takeaway is personal. Do not let any policy renew in silence. Read the changes. Compare coverage. Ask what is missing. Save documents. Treat insurance like a major household decision because that is what it has become. If this made you look at your own bills differently, like the video, share it with someone who just got a painful renewal notice and comment with this question. Which insurance bill is hurting your family most right now? Health, auto, home, or rent?